The AIM market is now 25 years old. It's been through a number of quite significant changes, and it's lost some money for people over the years, and it's certainly made quite a lot of money for people. AIM is not exactly a unicorn theme park, but a reasonable number of unicorns has emerged from it, and we've been lucky enough to ride on the back of one or two of those. AIM offers significant tax incentives for investing. Tax clearly shouldn't be the driver to investment, and nor do we claim to be tax advisors, but the tax incentives are relatively clear and worth understanding. In comparison to investing in unlisted companies, which is something we do also have experience of and continue to do, it does provide a degree of consistency in reporting and enforcement of governance standards, which, whilst not always perfect, are certainly a lot clearer than for unlisted companies. So it's not to say there are no issues or pitfalls, and we will cover some of those. This isn't the NASDAQ market, but it is interesting. So, as I say, it's seen a number of tricky years, but it does seem to be coming into its own. The market cap has rose to 131 billion last year, and it's now almost 150 billion. Last year in COVID, reasonable amount of money was raised, largely, particularly initially, to ensure companies stayed in business, and shareholders were actually very good in coming forward with funds to keep companies in business. And most of the money raised last year was for secondary issues, over 5 billion, which was in fact the largest amount raised since 2010. If you look at the columns on the right, the furthest right-hand column, you don't need to read the scale, was I think to the end of May, by which time almost as much money had been raised as for all of 2020. So we're at the moment on trend to raise twice as much as last year. And so far this year, we've seen 30 new companies come to the market, 30 IPOs, which is more than all of 2020. Slide, Rosie. Whoops. Got the next slide. Almost. So it seems to be working as a marketplace very well for life sciences and tech. Again, you may not be able to see the labels, but you should be able to see the colors. On the right-hand side, we've got the market as it looked 10 years ago. The big brown block, the size of the blocks is the relative market cap. The big brown block is the energy sector, and the big grey block is basic materials, so mining, and they accounted for almost half the market. If you see them now, basic materials has disappeared down into the bottom right-hand corner, and energy is still there, but far, far less. So the market, which had a reputation for being a sort of wild and woolly place for emerging market mines and energy, very speculative energy exploration companies, oil exploration companies, has changed characters completely. One of the, in fact, the biggest things that's emerged over the last few years has been some of the internet retailers. So ASOS and Boohoo are the two best known, and they're a big part of that block on the left-hand side. However, what you can also see, the light grey next to that is healthcare, and the blue block next to that is technology, and the block below healthcare is industrials, of which there is a fair bit of technology as well. So they've become much more significant parts of the market than used to be the case. Next slide. Yeah, a couple of slides just on the scale of the market, but particularly on the secondary market. So that's the slide on the right. You can see that the volumes really have picked up. Liquidity is not consistent. It's a market maker driven market, and the market makers are not enormously well capitalized. So you certainly can't be sure that there will be consistent liquidity in all stocks at all times. But it is possible. It is possible to trade. Right, and that will be the end of the slides. So just to backtracking a little bit, if you go back, the peak of the market in terms of the number of stocks listed was actually 2007, so before the financial crisis. There were over 1,700 companies listed. Average market cap was quite considerably below 100 million sterling. The peak number of IPOs in 2005 was almost 400. So that compares with 30 for the first half of this year. Many of them were absolutely tiny and came to the market really way before they should have done. There was a big clean out in the global financial crisis, which coincided with the end of the so-called super cycle in resources. And that washed out a lot of companies that should probably have never been on the market, but also unfortunately removed some of the institutional interest. It then went through another tricky period around the time of the Neil Woodford debacle of what, 4 years ago now, where Woodford had very concentrated holdings which had to be liquidated at bargain basement levels, and this concentration was amplified by him having worked with a couple of other funds who tended to have strangely very similar holdings. That really is out of the market now. Institutions have been coming back. It would be good to see more. On the other hand, that would be more competition for the interesting stocks there. But the market has definitely revived, and the underlying things working in its favor, so the continued availability of enterprise investment scheme and venture capital trust tax breaks have supported new fundraisers. The venture capital trust managers, firms like Octopus, have continued to grow. The inheritance tax break, which is on many AIM companies, remains there, and that's further attraction. Has to be said, that's not without political risk over time, but it seems pretty embedded at the moment. EIS at 30% is a big advantage to the market, and I think it would be a brave politician to interfere with that. So 30% tax and the opportunity to shelter capital gains is important, and there doesn't, touch wood, appear to be any great risk attached to that. However, accessing new issues with EIS is not straightforward for private investors. And one of the services that LGB provides is to work with suitably qualified private investors to help them gain access to what would otherwise be institutional offerings. And those remain the main way in which money is raised. Stepping back a bit, because there is a lot of talk in the press and elsewhere on reform of regulations, one of the things we'd love to see would be a change in the prospectus directive, which was designed to protect investors, but in fact actually locks a lot of investors out of the market. Interesting companies are definitely raising money at the moment. We continue to see very exciting companies, often very early stage, but raising sensible amounts of money that should keep them going for a period and not lead into cash crunches, with managements who, whilst they may be new to their companies, have track records elsewhere with good IP. And Simone will talk a little bit more about the way that we look for companies. And we're also starting to see some new classes of investors come into the market, particularly the American so-called crossover funds, who are venture funds, who in the US would be investing only in private companies, but see in AIM a way of getting into companies with IP and potential that they wouldn't otherwise otherwise have. This isn't NASDAQ. We've got to be realistic about the market scale. So the entire AIM market is only about 1% of the whole of NASDAQ. Tesla alone raised more money last year than was raised on AIM. And NASDAQ sees, I think, 1.8 billion trades a day. AIM is not much over 100,000. So you know, the London Stock Exchange would love to see this as another NASDAQ. It's not. It's a different animal completely. But here's also an opportunity, because these days companies can't get listings on NASDAQ with a market cap of that much less than $1 billion. AIM is still seeing companies coming to the market occasionally with market caps of under 20 million, certainly raising under 20 million. The biggest AIM companies are only the same size as the average for NASDAQ. So it's a different scale, and it does mean that that we are from time to time seeing companies who might have an ambition at some stage in the future to move to NASDAQ, but it's not practical at the moment. And really that is an opportunity. There's one company which is IPOing at the moment that we've been looking at and think is very interesting, which is actually a Texas-based company, but it has sufficient UK operation to have EIS, and it's coming to the market because a couple of companies doing what they're doing, which is AI-based diagnostics, have very successfully listed on AIM, one of which is now I think a dollar unicorn. So you know, you have a different venture capital structure in the US. The venture capital industry in the US is very supportive of early stage companies, whereas private equity in the UK has not historically been so much the case. And this does mean that investors, ordinary investors, can get a crack at early stage companies with interesting technology that would otherwise be restricted only to venture cap. Just a few words of caution to end up. It isn't all rosy in the garden. We've learned some lessons over the time we've been investing in AIM. You have to be careful of companies raising too little money, who are then seen as obvious candidates for repeat raises. There are the light touch governance does occasionally raise one's hackles. For example, there's no shareholder authority over remuneration. Occasionally you get managements who take advantage of that. Managements can be entrenched. I think the likelihood of external bids is smaller because the costs of a bid relative to the market cap are disproportionately large. Broker research is patchy. A lot of companies are only covered by one broker, and very often what they do is pretty much a rehash of companies' own releases. On the other hand, AIM Rule 26, which came in a few years ago, does mean that that actually companies' disclosure is really not bad and easy to find. And broker research, although since MiFID has become a bit restrictive, we find we can get information on pretty much all the companies that we're interested in. So we see interesting companies, and we're confident we can continue to show our clients interesting opportunities. At which point I'd like to hand over to Simone Westerhuis.
Thank you, Ivan, and good morning, everyone. So I will talk a little bit about our approach to investing in AIM at LGB. So it's always important when investing in any market that investors have a strategy or a framework that they can act consistently against. This is the only way to create a sustainable portfolio throughout market ups and downs, economic ups and downs, and it allows investors to generally ignore market noise. So this is true for institutional investors as much as for private investors. In many markets, it's sufficient to follow the market index, as this will provide a balanced exposure to business or economic sectors. For example, you could easily buy the FTSE 100 tracker. In the case of AIM, though, the index is not really representative of anything in particular. And indeed, as we have just heard from Ivan, it has changed significantly over time. So an index approach does not really work here. So what we do at LGB is we use a thematic approach. We have identified some top-level themes, which are digitalization, new age consumer, future of healthcare, and decarbonization. And within those themes, we're thinking around sub-themes, for example, clean energy, next-gen manufacturing, the Internet of Things, advanced diagnostics, just as a few examples. And we really think around companies in that context. The purpose of thematic investing is to be really at the forefront of technological developments and innovation and changes in the structure of the economy and society. AIM is a market for growth companies, and therefore it's a really good market to look for opportunities in this form of investment. Now, what happens is share prices rise when investors allocate capital into particular business sectors in anticipation of structural changes. For example, in the last year, we've seen significant money being allocated to clean energy and healthcare. And as a consequence of that, we've seen some really strong performances in stocks in these sectors. So as an investor, you want to be ahead of those trends and these capital allocations by institutions. So we will typically look for opportunities in companies with market caps between 20 and 100 million. They may still be under the radar of most institutional investors, but they will already have received some significant validation of their business model. So once you've identified some attractive themes, the next step is to establish an investment template or a set of criteria that can be used to assess individual investments. In our investment template at LGB, the most important criteria we think about is the quality of management and the company's business model. So we will typically look for companies that are helping their customers and business counterparties improve their productivity. So that means that we don't have to wait for them to build huge empires themselves, as it is likely that other counterparties will adopt their IP or technology and enable them to scale quickly that way, for example, through licensing deals or product adoption. We are not sector experts, but we look for businesses that have already received significant validation from counterparties who are experts in their fields. For example, the customers, the regulators, collaborators, peer reviews in the case of some new life sciences. So really proven business models. And finally, we rate recurring revenue business models very highly, as obviously revenues will become more predictable and visible. So the importance of these criteria is based on our recognition over the 16 years since we started our business, that no business plan survives contact with the market, and any strategy must be constantly assessed, as things always will happen that cause difficulty and present opportunity. The key predictors of success are how well a management team adapts and the strength of base on which they're operating. By nature of innovative growth companies, many AIM companies have management teams that are learning as they go. So we are looking for management that are able to really work as a team and regularly reassess the threats and opportunities which they encounter, as well as their own operational capacity. So then finally, when we have identified some candidates for investment, the next step is to focus on portfolio construction. And here, the two key factors are volatility and correlation. What we see in AIM is that share prices tend to be very dependent on RNSs, and most investors will have quite a short-term focus. So the difficulty with that is that share prices can be extremely volatile, and it's not uncommon to see share moves of over 10 or 15% in one day. But the positive of it is that there is not too much correlation between the stocks. So this is why it's so important to take a portfolio approach. So on this graph, we are showing a portfolio of 6 of the stocks we have invested in, with different themes. Some are in the same sort of top themes, but different underlying markets. And we're showing their movements over the last 2 years. So you can see that they are all moving quite independently. However, in the red, you can see how the portfolio has evolved over that time. And you can see that if you'd had all 6, you would have had a much smoother ride than if you'd had just 1 or 2. So if we look a little bit closer on the next slide, here is a table which actually shows the volatility of each stock. And you can see that the volatility is extremely high for these stocks, anywhere between 43% in the case of Crimson Tide to 129% on Futura. So it's a really high volatility levels. However, if you look at the volatility of the portfolio, it has come down all the way to 22%. So what that means is that the overall risk-adjusted return, which is the Sharpe ratio, is actually much better for the portfolio than for any of the underlying stocks. Thank you, Rosie. You can take that away now. So I also must, like Ivan, add a little bit of a health warning here, so that investors should not remotely make AIM the biggest part of their portfolio. It is important for any investor to keep a diversified exposure to different asset classes, including international stock markets, bond markets, property, etc. And the allocation here will depend on your overall risk profile. What we like to do at LGB is we like to include some short-term, high-yielding fixed income securities to our portfolios through our medium-term note programs. So our programs offer regular opportunities to invest in secured fixed income securities, often issued by AIM-quoted companies. And we like to add these type of instruments to our portfolios to reduce the volatility further and add some liquidity as well. So this is what we call our barbell approach, and I would be happy to discuss that with any investor who would like to learn more about that concept after this webinar. So just to summarize the key messages I would like to take to investors to take away. So first of all, think around your themes, use an investment template consistently, and create a portfolio of uncorrelated stocks to lower your overall volatility. You will get a much more comfortable ride. Details will always change, but the principle is robust. And with that, I will hand over to Andrew.
Thank you, Simone. So when considering the future of the AIM market, we should recognize, as Ivan explained, that it has come a long way. After starting with only 10 companies in 1995, with a combined market cap of just 82 million, there are now 734 constituents of the AIM All-Share Index, with an average market cap of 130 million and a combined market cap of 95 billion. So as Ivan mentioned, the market certainly took a wrong turn in the way. Before the financial crisis in 2008, some bright sparks at the LSE and the brokers attempted to turn what is essentially utility into a profit and bonus generating machine. The number of companies on the market reached almost 1,700, and there was a corresponding plummet in quality. So the attrition of the last 13 years has been very positive. And so my main hope is that the LSE and the company brokers will now focus and emphasize quality over quantity. This is the way to build the reputation of any market and to attract investors. We've also seen some consolidation among nomads and brokers over the years in terms of the numbers of these companies and the professionalism of their employees and their operations. This has been beneficial for investors and also for us as we work with these companies on individual transactions. Ivan also highlighted the relative status of the AIM market, and I think I also recognise that while the average market cap of an AIM all-share company is 130 million, the average market cap of companies on Nasdaq is over 2 billion, and it's just Nasdaq is just part of a much greater equity capital market. And as Ivan mentioned, the trading on Nasdaq is much more sophisticated. So, an average Nasdaq company might see 20% of its shares changing hands each month. A comparable figure on the AIM market might be just 4%. So, although it can't compete with Nasdaq, I do think that AIM will continue to be an excellent developer of companies in the important 50 to 500 million range. And at this point, or perhaps Ivan suggested £1 billion, a transition to Nasdaq or another larger market could be considered. So the regulatory burden and the ongoing listing costs are low. Research coverage, although patchy at the smaller end, is not bad, with 80% of AIM companies being covered, compared, for example, to about 35% of smaller Nasdaq companies. And the AIM rules, which Ivan referred to, ensure that meaningful information is distributed by the companies themselves. I think the fact that some Nasdaq investors and crossover funds have come to the AIM market is certainly a reflection that they're looking for interesting technologies and relative valuations, but I think it's also an endorsement that AIM companies are worth investing in terms of their corporate structure and governance. I remember that a US official in, I think, about 2005 called the AIM market a casino. So I hope that wouldn't be applicable today. So in broad terms, the structure and functioning of the AIM market are much improved and are fit for purpose. So the question is, what is the market's purpose? So we believe that the market's purpose is to direct private capital to areas of the economy that can ensure a sustainable future for us all. And I use sustainable future in the broadest sense of the phrase. So in this regard, my hope is that the constituents of the market will continue to change over time to reflect the key themes that Simone has identified. So Ivan showed us, for example, that healthcare and consumer sectors have grown in recent years. At the moment, technology is an obvious underweight. Many tech companies look first towards private equity, and I would like to see that changed. So this will require a culture in the market that encourages entrepreneurial endeavor and places less emphasis on exploiting the IHT and EIS tax breaks, although these will still be important. It also requires investors who are prepared to put capital at risk in order to do some broader good while making money for themselves and their families. And I definitely include our clients in this category. So I would like to conclude with a call to action. Become involved. If you haven't done so already, please ask Megan or Simone how you can open an account on our investment platform in order to participate in our work and help us develop some compelling growth companies. Thank you.
Great, thank you everybody. So we will shortly open up for Q&A. I can see there are some questions already, but please do start submitting your questions via the Q&A box. So as we have mentioned, at LGB, we've been helping our clients invest in AIM for over 15 years. And as Andrew says, if this is something that you're interested in, please do get in contact with us and we would be more than happy to discuss this with you further. Our contact details should be on the screen shortly, and we'll also follow up with an email after this call. Okay, so we can now have a look at some of the questions. So I think the first one we can go to is maybe one for Ivan. Would you care to comment on doubling up when you find a potentially winning AIM share, or selling out when things look unpromising, biting the bullet? You'll have to come off mute again if you're happy. There we go.
Yes, clearly you should double up when things are working. And very often when companies first come to the market, they're coming on a plan and looking for the funding to develop it. And if it works, and the share price responds and they come back for more, then the fact that they are potentially coming back for more at a higher level is a good thing, not a bad thing. And it's certainly one should not be reluctant to double up on successes. So yes, I think that does make sense, and you're not necessarily going to get EIS at every opportunity because companies can burn through that. But if it's working, and you have the original assumptions have been validated by what the company has managed to do, its plan for getting to market appears to be working, that they're getting licensing agreements, whatever it is, then you would hope that the market, it's nice that the market hasn't yet recognized it, and it will, but even if it has recognized it, that's no reason not to increase. And correspondingly, if it depends really why things look unpromising in terms of biting the bullet. Is it that they've been hit by events outside of their control? I mean, a fair number of companies that we look at were damaged by COVID in ways that they didn't necessarily expect. And that wasn't necessarily a reason for getting out of them, even if business was unpromising last year. In some cases, it becomes clear that the route to market was not as straightforward as they anticipated, that the management don't look as smart as you thought they were, or indeed they fall out, that competition emerges, in which case holding on in the hope that things will get better is that there are other opportunities out there. So yeah, wouldn't disagree. Are we always cute enough about advising on all those things? I'm sure we could do better. We will try.
If I can just add to that point, from a portfolio point of view, obviously what happens with these extraordinary performances, either up or down, is that even if you start with a balanced portfolio, very quickly the portfolio balance goes out of kilter because one stock will have completely outperformed others and others will underperform. So we're not looking to constantly recalibrate the portfolios to bring it back. But what we do like to do is when a stock does really well, we do like to take some of our money out. So for example, if it has tripled in value, we do like to take a third of the table to cover the original cost, and then that exposure, it becomes more or less risk-free, if you can see it that way. And equally, if a stock underperforms, it goes all back to the investment template and the approach I was discussing earlier. Is the management actually reassessing the business case? Is the business case still there? Has it changed? And then we can take a view at that point.
Thank you. The next question I think would be for Simone, so back to you. Do you have a recommendation for the split between investing in equities and private debt within an AIM portfolio?
That all comes back to the investor profile and the importance of liquidity and income in that investor's profile. So, it's a discussion I usually have with the investors, what suits them best. The fixed income portfolio is very much all around, creating income and creating liquidity. The aim is a much longer term approach in actually trying to build a portfolio which is creating real value. So it is completely dependent on the person's circumstances. But generally speaking, we would go probably 60% to the fixed income or 70% to the fixed income and 30% on the equity.
Thank you. And we've had another question. Where do ESG credentials fit into your thematic investing? Maybe one for Andrew, if you're happy to answer that.
Yes, we don't have a specific ESG criterion for selecting companies. I think we're still at a relatively early stage of understanding the implication of ESG on investment portfolios, and what we don't want to do is jump onto a bandwagon or to pick up on some catchphrases which could potentially limit the investment returns or enable or result in our clients having suboptimal portfolios. But I mentioned that we believe that the purpose of the market is to create a sustainable future for us all in the broadest sense. And so we are thinking very clearly about the responsibilities of companies, both as a virtue in themselves, but also as part of creating sustainable business models for the future. So, for example, in the past, we have invested in one or two companies that have been associated with the gaming sector. I just don't think we would, those would get through a screen nowadays. Partly because of societal factors, but also because of portfolio factors. How sustainable how sustainable a business model can you create in that sector? So I think the best approach is to continue to learn more about ESG and to apply it, yes, as a virtue, but also as part of a sensible investment strategy.
Thank you. And then over to Ivan. Given the financial situation the government finds itself in, do you see it as a risk that the IHT benefits of AIM investment may be revoked?
Yes, I think there is a risk, and actually this comes back to another question as well. So the IHT benefit is a bit odd, but it goes back to AIM's predecessor, the USM, which is called the unlisted securities market. Technically, companies quoted on AIM are not listed. It's only the main stock exchange list, which makes it listed. As a result of which, they were still considered and are still considered, with certain qualifications, private companies, and therefore are eligible for business relief, business property relief, i.e. Inheritance tax relief. A quango called the Office of Tax Simplification in, I think, 2019 looked at this and said this was, and indeed, if you look at ASOS or Boohoo with multi-billion market caps, is it clear why an investment in those companies should be exempt from inheritance tax, whereas an investment in Marks and Spencer, which I think now has a lower market cap, would not be? I think it would be, frankly, a bit of a struggle to defend that. So is it vulnerable? Yes. Is there any particular imperative? No. Would it raise very much money? No. What might happen? I don't know, best guess. They might restrict the size of companies on which IHT relief was available, but retain it for the smaller companies. I don't know. I have no political insight on that particularly. but pragmatically, they're not going to want to damage the AIM market unduly, but they might well chip away at the more egregious end of the exemption. And just FYI, if people aren't aware, listings on NASDAQ do count as listings as far as the revenue is concerned. So once companies get dual listings, they lose that exemption.
Great. And then I think a final question. There's quite a lot of frictional cost in both the IPO process and secondary trading through market makers. Do you think that there might be alternatives through technology to reduce this? Andrew, would you like to take that one?
Yes, so when I was looking at the comparison of being on NASDAQ versus being on AIM, I was surprised, or well, perhaps I shouldn't be surprised, but I saw a figure that to be on NASDAQ would cost £2 to £3 million a year, meeting the regulatory burdens and all the other requirements of listing. And so the cost of being on the AIM market for companies of, of £200,000 to £300,000 is actually looking quite reasonable. I don't think that there is going to be any reduction from that point. I think with the regulatory burdens generally always head north. I think the reduction from some years ago has been brokers taking less money, but I think we can expect that it's probably around the bottom. In terms of the in terms of the marketplace, the dealing systems, I mean, there is now quite a lot of technology. So more and more broker platforms are, being allowing simple online trading, and my experience of using Interactive Investor, for example, is that they're constantly working to find the best price they can between the bids and offers of the various market makers. So I think that we can hope that as the general market improves in terms of quality of companies and the average size of companies, dealing costs will continue to come down. I'm not sure that there needs to be any particular technology innovation to make that happen. I think that with regard to investors, looking at the frictional costs of, or the marginal costs of trading, I think the risks appear in the, the custodian level. For example, SIP account managers and other intermediaries in the holding of shares. Because what we've seen there is that the regulators have actually asked more capital to be allocated by custodians and other fiduciary counterparties. So if I were looking to, minimize the costs of being an investor in the AIM market, I wouldn't necessarily expect much improvement in the cost of trading, but I would look for the most efficient means of holding my shares.
Thank you. Okay, I think that's everything we've got time for. There are a few questions that we haven't answered, so we will follow up with people for those. But as we say, please do get in touch with us if you would like to hear anything more on this. And thank you very much for coming along today.